So we're very privileged to be joined by Andrew, who is Andrew Ratu, who is our PAYE specialist and deals with all our everything PAYE for us.
Correct. It's a good job I love tax. Really.
Well, some people say it's taxing, but it's not taxing for you.
Do you love it? Do you love it as much as I love it?
I don't know.
We'll find out, won't we?
We'll find out. Well, so it's just to really sort of get an understanding of what a benefit in kind is, what comes up commonly in the PAYE investigations world, and what people commonly get wrong when it comes to benefits in kind and P11Ds, and actually what is a benefit in kind first and foremost.
Yeah, I'm sort of looking forward to this. It's going to be good from an employer and from employees.
Good point.
It affects both, doesn't it? So
yeah,
it's going to be interesting.
So what's a benefit in kind?
Where do you want to start? Well, basically, the way to look at a benefit in kind is obviously something that the employer provides to their employee that the employee can use for personal use or has personal use of it. That's what effectively is the best way of describing it, really. It's a perk. It's a perk, and you have to test whether that perk is taxable or not.
Okay, so it's really what could be deemed as an extension of salary that isn't included within your salary.
Correct, yes, because a perk or a benefit will be added to your salary as a taxable item, and that will attract tax and potentially NIC as well.
Okay, yeah, okay. So that will be NIC, or national insurance contributions for the company and for the individual.
It can be, for the majority of benefits in kind, true benefits in kind, it's that the company provides. The company pays the NIC on behalf of that particular asset. You can get obviously situations where the NIC is also payable by the individual, but let's just stick with our.
So it could be here all week otherwise.
The main ones are basically covered by the company paying the NIC.
Okay, so then when we're looking at those sort of things, that could be anything from health insurance, so like say, I don't know, Bupa or whatever. Yeah. That could be company cars.
Could be company cars. Yeah, those are probably the two main ones actually: company cars and healthcare.
So would it be like mobile phones and laptops and that sort of stuff?
Mobile phones, not necessarily. If an employee is provided with a company mobile phone and it's one mobile phone, primarily used for business purposes, then that does not attract a benefit at all. Okay, so that could be a smartphone, it could be anything, and they can use the individual employee can use it for private use as well, and that's simply because the contracts are so complicated these days. You can't really split what is business, what is private. So so the company providing individuals with mobile phones or a company provided phone is not a taxable benefit. If they've got two or three, that's a different matter, because that's obviously where you get into friends and family. That's but one mobile phone is not taxable.
So then that's if I'm say, for example, me using an employee of All My Rutter, that would work for me. But let's just say if I'm an own and managed limited company, so I am the director. Basically, it's only me and a limited company.
Yeah, no other employees.
No other. Yeah. So could my own company provide me a company mobile phone?
Yeah, sure. Yeah. As long as that contract is in the company name.
Yeah, okay.
That's the key.
The key, of course. Yeah.
It gets a bit more complicated, doesn't it, if it's in your name and the company's.
Yeah, because the reimbursement procedure that can attract a different level of different interpretation of tax. So stay away from that. If the company provide that phone, it's in the company name, a company contract. Then yes, that is effectively a free phone for use private and business.
Okay, so then when it comes to things like cars, and cars I can imagine are very simple for P11Ds and benefits.
What planet are you on?
That's a man that hasn't been a P11D before, isn't it?
Dear.
What, supposed to declare it?
So company cars are the main ones. Yeah, a company car, if it's made available to the employee for private use, then effectively that is a benefit in kind, and there is a formula for working out what that benefit is, and that depends on a couple of things: the list price, the CO2 emissions, and actually the percentage that HMRC put on the scale of how that benefit is calculated. Okay. And that's an extension to somebody's salary. Okay.
Yeah.
Okay. Yeah. So effectively, if it's available for use for private use, irrespective of whether it's used or not, if it's available, it will attract that benefit.
Yeah, okay.
And
Yeah.
that's the key. So, and what people tend to forget is the fact that, oh yeah, I just use it for going home to office work, makes no difference. The commuting mileage is private and therefore it attracts that benefit. And that's what people tend to forget.
Yeah, the thing that I see come up a lot of the time as well is on the list price. A lot of the time people think it's what they've paid for it.
Absolutely,
Is it?
Yeah, the benefit is based on the list price, which is the manufacturer's list price, which comes out of the factory. So yeah, and so you get these deals that come along, sort of saying obviously £5,000 off here, £10,000 off there. Makes no difference. It's stuck with the list price. The benefit is based on the list price of that vehicle.
I remember back in the old days, and this is going back a long time now, and this is just quite a funny little story really. So when I was at my old practice, we had somebody who went out and bought a company car as a Rolls Royce. Okay.
Yeah.
Now they didn't. It wasn't a brand new Rolls Royce. It was quite an old Rolls Royce. So I think they paid something like 15,000 for this Rolls Royce. They were very upset when I turned around and said to them that their PLMD value was based on the list price of the car. New, so it was like a £250,000 car, whatever it was. So therefore, they're expecting to pay a tiny, weedy little benefit because they went out and bought it instead of buying a 15-20 grand car. So I think it was instead of like let's just say a Corsa or something like that. Yeah. They went out and bought this, so they ended up having the large benefit in kind on the car, which obviously threw them completely. So the list price is something that really catches people out.
It is indeed. That's right. Yeah. And the other thing that catches people out is the fact that occasionally you'll find that employees will want to make a contribution to the use of that car, but if they pay something like say £5,000 a year towards that benefit, but the benefit is actually £10,000, they still have to pay that difference. Yeah. So people think they're making a contribution that removes the benefit. No, it doesn't. Even if the contribution they make is actually like the monthly rental or the monthly lease of that vehicle, if the benefit is a lot more than what they're paying in terms of their contribution, then effectively the benefit in kind still arises. They get a credit for what they do pay, but even so, there's still a benefit to be had.
There's a difference.
And people tend to forget that. Obviously, the fact that HMRC will pursue that if they see it.
They'll catch you out, won't they, with that sort of stuff.
So, like, following on from cars, so if you've got a car, what about the fuel then? If you're given fuel?
Yeah, company fuel. That's another benefit. That's a separate calculation. So again, that can be quite costly if you get company provided fuel, so the company give you a card or a fuel card in order for you to fill up as and when you want, then effectively that is a benefit again, and that can be equivalent to the actual level of the car benefit itself. Okay. So it's important if you want to reduce that benefit and you do have a company car, it's to know what business miles you actually travel against what private miles you travel, and therefore we can work out a percentage of what that benefit should actually be. Okay.
I've got a curveball question now.
Here we go.
He loves these.
So I get my car, okay, and let's just say my car is a Tesla, okay. I have no fuel on that one, so therefore I charge my car at home. Can my employer pay for my electric?
What a question!
Because I get asked that all the time.
Okay, well, the thing is, electricity is not a fuel. Okay, it's an energy. So that's the first thing. There's a big thing with regard to that. So okay, but the only way of actually obtaining any form of relief or reimbursement for the electricity you use at home, most chargers now, they didn't used to, but most chargers now have some form of like input, so that you know what sort of level of charge is going through into the car. Okay, so so they become a little bit more sophisticated. So if you know what your charge is and how many kilowatts that car is using, effectively then you can actually work out from your bill what that car is costing to charge. Okay? Then you have to identify from what travelling you do between business miles and private miles, what element of that, what percentage of that charge then relates to business or what relates to private. And obviously therefore you can claim back the business percentage of that. It's quite involved, it's quite complicated. There is an argument obviously that HMRC are reviewing this, and obviously because of the fact that energy is not a fuel. But the jury's out on it at the moment. Basically, if you can identify the level of business use of that personal charge you're paying for home paid for electricity, then you have a case in which to claim back that from your employer.
But you can claim back a mileage element, can't you?
You can, if you can base it on, I think it's 5 or 6p a mile. You can claim that as use of, but with charges as they are, That's a difficult one.
It's a very complicated issue, but I can imagine it's become more and more and more common, isn't it, in our world?
Yeah.
Because people are getting these electric company cars,
Yeah.
and I'll come back to how they're treated in a second. But when we're talking about whether you get reimbursed the electric or whether you get reimbursed a mileage element, the simplest way is going to be looking at how many business miles that you've used that are charged at home.
Yeah, if it's your own, if it's your own Tesla, good for you. If it's your own Tesla and you use it for business, but then you can still claim the 45p a mile. Obviously, you can still claim that, because that's the wear and tear of a car.
Yeah.
But if it's a company car and you want to claim back that particular amount of charge that you're paying for personally at home, then you have to have a formula in which you actually can identify that business mileage.
Yeah.
That's when people get confused on a lot, isn't it, with company cars? I think they can claim the 45p and 25p.
Yeah.
But that's only if it's your own car.
If it's your own car,
that's
right.
yeah. So we've talked about if I'm an employee and how that works.
Yeah.
So what happens if I work for my own limited company? It's just me working through a limited company. I don't know. I'm a plumber. I'm gonna be a plumber again, and I've got my Tesla that I have sort of like to get around in. Obviously,
You're doing very well, aren't you?
Yeah, do you know what I mean? Plumbers do all right. No, plumbers do all right. So especially when it's in my Saturday job as well. So I've got my Tesla, my limited company, because it's me owning a limited company and it's effectively my company and my car. Do I have to do a P11D?
Yeah. If the company have fronted up that car, if they paid for that car, if that car is in the company name, and effectively that is a company car and it's reportable through the P11D return.
Even though it's my company and I own
Makes
the
a
company
difference.
and the car.
You've got to think, obviously, you and your company are two separate people, really. Obviously, that company is a person in its own right, which means that company has fronted up the money for that particular car, be it as a one-off payment or as a monthly lease or rent or whatever. So that company is providing you with a car for personal purposes, and therefore that means it potentially carries a benefit in kind.
Yeah. Yes, to be clear, this has been limited companies. Isn't
Yes,
it? If it's sole trade or partnership, it's different.
It's different. Yeah, this is
what
yes.
we're talking about today, really.
Yes.
Yeah.
Thank you. Clearing that one up for me. So the other one that I see quite a lot is health insurance, both for people who are employees and people who are sort of owner managed limited companies.
Yeah.
So then, if in both scenarios, in that case, the employer is providing health insurance. So whether it's my company, my owner managed limited company providing insurance, or my employer, I still have to do a PLMD for both of those.
And the only way that doesn't happen is if you make good, obviously. So that means if the company is paying premiums on healthcare for say $3,000 a year, unless you pay that $3,000 back to the company, then that $3,000 will be a benefit in kind. Okay, and again, that's reportable on a P11D. And that healthcare can actually cover yourself and family, as well. So, but those premiums then are all chargeable through PLMD process.
On that individual that's obviously the employee, not the employee, say husband or wife, that's nothing to do with the company.
Right. Yeah.
Okay, so I can imagine that will catch quite a few people out, because particularly in the owner managed limited companies, because they probably won't consider that a PLMD is relevant because they're not.
It's often forgot about, obviously, from that point of view. It's something they need to be careful of, because it's you just become oblivious to think that you are not the employee, but as a director you are still an employee.
The company's a separate legal entity at the end of the day, isn't it? So you're an employee of that.
So we spoke about extensions to salary and these extra things that can be benefits. So obviously we spoke about cars and health insurance, whatever. So let's just say that I've left my job as a plumber. Right. And I've now got a job in a pub or a restaurant, okay, and people give me tips. So tips, I can imagine, can be quite, because that's not my employer giving me money.
I'll give you a tip. Go back to being a plumber.
You had a Tesla as a plumber, didn't you?
My Guinness wasn't that bad. I thought I poured you a nice Guinness. But I think that if I was, I get paid for doing my by the pub for my hours worked and all that sort of stuff. And Mark, who's not very generous normally, but Mark gives me a £20 tip because he was very, very impressed with his pint of Guinness. More impressed with yourself.
Too right.
So how does that work?
Yeah, tips. Yeah, you've got to be careful with tips, because tips, again, it can be a wide range of things. But effectively, if somebody like a paying customer, leaves a tip on the table or just hands a tip to an individual, then effectively that tip, we'll call it a cash tip. Okay,
Yeah.
that tip effectively is reportable by the person who picks it up, effectively, unless they go and put it into a tin for everybody else to share at a later date. Effectively, that becomes a cash tips. Cash tips that are picked up by individual waiting staff or bar staff, whatever, and they pocket it themselves. It's their responsibility to tell HMRC that they've received X amount of tips per year, so that gets coded out effectively in their tax code. All right,
Yeah.
because they are an employee. Okay, that's how that part of it is accounted for. Other tips where you have, and this is obviously probably more common now because we're entering into cashless society, obviously, where people just pay tips on cards. And it's effectively sometimes you don't even know you're paying a tip. And it's part of a card payment.
Yeah.
If those tips you've got to be a little bit more careful with, because if they're just shared out by the owner, director, or manager, not the manager, but of the owner of that business, effectively that owner is telling those individuals what they're getting, and those tips are then taxable.
Right. Okay. And national insurance.
And nickable, and that's key. They're nickable simply because they actually form part of a salary or a payment or a wage. Okay. If, however, the tips are all gathered up, put into a pot, and then it's up to the manager or one of the members of staff to identify who gets what, then effectively that is dealt with through what we call a trunk. Okay, which is, again, it's a payroll type process, but it just attracts tax. It doesn't attract NIC. There's no NIC charge on that. Okay, and that's. It sounds like it's more hassle, but it's probably more relevant in the current way of thinking, simply because it enables the staff to have a say as to who gets what. Okay, and of course it means they can share it with the kitchen staff who don't normally get involved.
Yeah.
And obviously now, and the government actually. We've been talking about this for a while now, and it hasn't happened yet, but obviously there is a move with the government to make tips and tipping more transparent, and so that every business that is involved in has a tipping regime is going to be required to be more transparent in how it actually splits up and divvies out the tips, so that the staff know who's getting what. Okay? It just still means that maybe the head chef can still get more tips, or more the tips it should, because probably they're more classed to be more important, more relevant to the success of the business, what everybody else gets. Head of staff, front of house, they may obviously, because of the way they actually conduct themselves, may warrant a bigger share of the tipping pot. Okay, but so long as it's not the director or the owner that actually divvies up that amount, then effectively it's just taxable and not nickable. All right, okay. It has to have that independent feel about it, and obviously with this new move for HMRC wanting to make the process more transparent, it's going to bring it more into the fore. Obviously, what people need to do.
Yeah.
Okay. And the thing called the trunk, effectively, I think it's a French expression. I think it sort of comes from meaning of poor box. Obviously, it was like used to be a trunk used to find maybe in a French church, and people used to throw their odd change in there.
Yeah.
It would then split amongst, obviously, so there's the less fortunate members of the public. But from that point of view, obviously, it's just a way of splitting up money. Obviously, that is graciously given by the paying punters.
Yeah, so not an elephant's trunk.
Not an elephant's trunk.
Whoa,
why are you putting that one on me? You were thinking that. I was thinking very professional, actually. Makes a change.
Well,
I think the key thing on that is, if you're in the industry where tipping is, don't ignore it. Treating it properly. You're not sure.
Absolutely.
There are moves afoot, obviously, and trying to get your head around it is obviously can be quite daunting, but it's quite an easy process once you actually get into it.
Yeah, it's just getting into it.
The key is that it's not the owner or director who's involved in that particular divvying up or splitting of the tips. If they are, it becomes part of the wage and then becomes nickable as well as taxable.
Yeah. So there's many different things that people do miss, to be fair, within that, or not miss, but probably bury their head in the sand actually, and go, well, I know there's probably a problem here, but
it's easier just to.
And it's easy. Go on, Mark, you can say it. Go on, I'll let you say it. Mark has this thing where every podcast he always says that basically it's always better to
prepare,
that's right, and be proactive, forward planning. So it's always better to think ahead of these things. I'm going to think of another one. Think ahead of these things and put the procedures in place. If you think there's the slightest thing, well, actually, I'm not too sure, or there must be, I'm getting money here for free, really, I shouldn't be. then that's when you'd start talking to us, really, isn't it? And start
that's right.
Those conversations, really. We put those. If you have done something wrong, we can try and fix it.
Yeah.
But actually, it is damn sight easier to
get it right.
Yeah, well, if you're not sure, you go on the mantra that everything is taxable. Particularly when it comes to sort of transfer of money, from one person to another, there's potential tax implications. And obviously, if you're not sure, then you just ask.
Yeah, that's what we're here for.
Absolutely, exactly. Yeah, there's point of having experts if you don't ask them questions. I'm just going to ask, do you know what? Do you know an expert?
I know a good plumber.
So he's loaded, absolutely loaded, this bloke. I'm a better plumber than I'm a bartender. So with obviously the investigation and all those sort of things that come up, is there a common thing that people are missing, or a common thing that sort of the revenue are leaning towards, or is it just
varies.
look at the draw?
It does tend to, like, cars are the big thing that people tend to sort of have the wrong interpretation over frequently. Pool cars. There's another one actually.
Say that one.
Pool cars, that people that take pool cars home on a regular basis. You've got to be thinking that's not a pool car. Because you're getting into commuting use of that car, which is not right.
So what is a pool? So what should a pool car be?
Well, a pool car is a car that's available to all employees who are able to effectively use that car for business purposes.
Yeah.
It's not meant to be allocated to one person on a permanent basis. There has to be proof of records kept of why a pool car is deemed to be a pool car. So effectively dates of use, where it's gone to, time in, time out, what expenses were incurred on that car, driver who's used that car. That's probably the because HMRC will pick up whether or not how many times that person's used the car. And if it's to the exclusion of everybody else, that's a personal car. It's not a pool car.
Rick, should it be kept at the company premises as well?
In strictness, yes. Ordinarily, it needs to be kept overnight and at weekends at the company premises. It can be used on occasions, and it is on occasions if to facilitate an early morning start for somebody, or a late night return, out of hours return. Then obviously, then it makes sense that the car can be taken home on those occasions. But if that becomes too frequent, because again, it's being used by the same person, on a regular basis.
They'll see straight through it.
Again, they'll steal straight through it. You're right.
So going back on cars, then. So we've done company cars. Mm-hmm. Where do vans come into this? And there's a crossover, isn't there? Things like double cab pickups and
vans actually can be made available for private use. But if you have a van, which is used for business and private use, the benefit is much, much lower. It's much really tax effective to have a van, and have the benefit charged you on that van. It's probably just under £4,000, and the van fuel is around about £700 as well.
That's flat.
And that is a across the board charge. Vans themselves, actually, if they're just used purely for business, don't attract a benefit at all. And if the business that you're in, maybe construction, plumbing, whatever, you have commercial need for a van, and obviously that van then takes you from home to site, as opposed to home to office on a regular basis, then effectively that van will not attract a benefit at all. So long as the company has a policy which sort of says, right, okay, the vans are not to be used privately, okay?
Yeah.
And that means not taking it down to the beach or surfing down the corner on the weekends, Neil.
Yeah, I'll do that on the regular, to be fair. I'm a regular surfer. Or down to football.
Yeah. You have to be careful, because the thing is, you mentioned, Mark, double cab pickups. Yeah. Double cab pickups are, normally a van isn't obvious what a van is, but a double cab pickup is a van so long as it's got a curb weight of 1,000 kilos, and it's actually used for, you can see it is a purpose-built commercial vehicle, and they actually still are classified as vans. Although HMRC are in that particular area of workup, you can see that, and you also find now you've got double row vans, double van, and those now the big Coca-Cola case, which is still going on at the moment, I believe that they become multi-purpose, and there is a very strong argument that those transits or those Vivaras, whatever, because they've got a double line of seats in the back, actually removes their status of being a van. Okay.
Even though they're deemed commercial vehicles.
Yeah.
We had it with the which one is it? It's the VW one. You got the VW vans anyway. You got the back seats. And the back is a van, but so people use them for but they're not classified as vans, are they? Those.
That's what the Coca-Cola case is looking at, wasn't it?
Yeah.
They provided a load of employees with those double row vans.
Yeah, the VW combis or the
That's it. It's combis. That's
transporters. Those actually are classified as cars now. You know,
Yeah.
and they make the van dealer will say, yeah, no, they're a van. You know, but HMRC take a different view. And if you've got a double row of seats in a VW transporter or a combi, then effectively they treat that as a car, and it's quite an expensive car.
Yeah, well, the list price is high.
Yeah.
You know, they're very expensive. They're quite expensive vehicles.
Yeah, on the same sort of fronting, like Land Rover Discoveries and Defenders, that one that comes up all the time, like the new Defenders, people are buying those,
Thinking they're vans.
but there aren't that many that qualify as vans from what
That's
I've
right.
seen.
No, the thing is, like your typical Land Rover will probably be a car. To be fair, you know, you will probably find certain Land Rovers which have been blacked out and there's no access to the back from a seating point of view. They could probably they're on the verge of being probably vans. So obviously, you know, they're commercially built to be a van.
Yeah.
It's if they've got the bulkhead, I think, isn't it? That's
bulkhead. That's a
solid
good word.
bulkhead.
That's the word. Bulkhead. Find out where the bulkhead is. You know.
There you go. I'll tell you what, bulkheads, there you go. Mark's on fire today.
That's right.
You should get a job in taxi, Mark. I tell you.
Yeah, van. See, there's a lot of mileage in HMRC pursuing vans to be cars. You know, so but just to reiterate, the double cab pickups still at the moment the majority are vans. You've got to be careful of those that don't quite meet the 1,000 kilo curb weight. Because if they put then the cover on the back, they get over that 1,000 kilo. But if they take that cover off and they're less than 1,000 kilo, they're a car.
Yeah, that's it. Yeah,
it's you know, it's a complicated little minefield. But obviously, you just need to be aware that the genuine vans are tax effective.
Yeah,
and they're quite expensive vehicles, so the tax implications can be quite big.
Absolutely, yeah.
So my advice would be always speak to us if you're unsure before you buy one to see what our opinion would be on whether it's going to fall as a car or a van.
That's right.
Yeah, because otherwise it could cost you a small fortune in tax
every year.
And your employees, that's true. That's true. Yeah. So it can be a bit of a minefield with these, especially vans. Vans sound more complicated than cars. I thought cars are complicated.
If it's a van, it's fine. It's just identifying if it's a van or a car. Yeah, that's the.
Just get yourself a low loader.
It's not quite so glamorous though. But I think that, you know, is there anything else that sort of comes up that people are getting wrong frequently?
Well, moving it is presumably part of like we call benefits and expenses. So expenses you've got to be careful, obviously, with regard to getting out and about and what people pay. Obviously, when they're out and about driving or travelling on business purposes, you know, there are rules to follow there. And obviously, and what people tend to forget is if they get paid a ransom allowance, that's not necessarily the thing to follow. Obviously, a ransom allowance is taxable. You know. You have to have a purpose. You have to have receipts to show what you spent that money on.
So the ransom allowance is just going when you say, for example, I go and stop away for a night, and they say we're going to give you 50 quid.
Yeah.
And the 50 quid, whether I spend that 50 quid or not, that's effectively what it is.
You could go and sleep in a bus shelter and pocket the 50 quid.
Yeah,
that's 50. That 50 quid, actually, that 50 pound would be taxable and nickable.
Unless I can show that I've spent it with the receipts. You're saying, I interrupted you there.
So that sort of thing, you know, that could be a whole different minefield. But obviously, this is the thing that does tend to come out quite frequently. Is that around some allowance is paid because it's helpful for just to give people cash to play with. But if you don't keep the receipts of what you spend that money on, effectively it can be a chargeable source of income. You know, fortunately, most employees now have company credit cards, which means that what they actually spend that money on, or what expenses they incur, can be traced through obviously quite effective means of receipt and payment process.
With third-party proof, yeah.
But obviously what people tend to forget when they do actually sort of use cards, they don't pick up receipts, and you've still got to have the receipts, because the credit card descriptions do not cover everything that HMRC will accept as being correct and proper.
Yeah, sometimes they just have the name of the business.
That's right.
Yeah, and again, when people buy stuff like on the internet, they don't, you know, what could you get a receipt on the internet? Very rarely. And you don't know what you're buying because especially late at night, the expense detail isn't there. So it is important to make a note of anything that's bought over the internet, particularly business expenditure that is incurred by anybody. That is.
Well, if you don't keep the flip side as well, you can buy anything personal on the because you go to Amazon, you can buy anything from Amazon. You can buy literally anything.
Won't say what it is, will it? So
that's right.
Just Amazon.
Just be mindful of that, because again, that's another area of detail to be mindful of. But it does happen because that's all part of the P11D process as well. You see, that can get reported through the P11D.
Yeah.
Personal items being purchased, have to be reported through the P11D.
I've got another random question coming now. Just popped into my head. So, if I've got a company credit, my personal credit card, right, and I use that to pay, or a company credit card, let's just say company credit to start with, keep things simple.
Yeah.
So, I've got an American Express company credit card, and I buy everything on that company credit card.
Yeah.
I accumulate, obviously, air miles.
Yeah.
What happens with those air miles?
Well, effectively, if you've accumulated in your name, then you can use them. Okay.
Yeah.
Okay. Now, don't get confused, obviously, with that, because it's not as straightforward as you think. But normally, if those air miles are in your name, then you can use them. Then that's okay. That's okay.
But what's the company's name? Because they don't exist in reality. They're just.
Well, that's up to the company how it actually can actually look to redeem those in any way, shape, or form. Because effectively, if the company is able to provide the employee with any form of facility to use those air miles, because that's something that's been incurred from a business point of view, then the company has first say on it. But it's up to the company what they do with it.
Yeah.
And if it's, you've got to watch it, you don't overstep the mark with regard to that.
Because I think it's a bit of a mind, because obviously that's going to be quite hard to police from a HMRC point of view, but equally quite a hard point of view, because I'll go, it's my company, they're my points.
Yeah.
Or it's my credit card, they're my points. But effectively, I've then gained a benefit then, haven't I, really? Because had I not have been in the business using the credit card for my business, I wouldn't have incurred those costs. I wouldn't have those free flights to America for 3 months.
It's the company paying the credit card.
They belong to the company, really. That's what it boils down to. You've got to look at the small print with regard to what you're getting into with regard.
Yeah.
That's interesting though. It leads me on to sort of things. So if the company gives an employee vouchers, when does that become a benefit, or?
What sort of vouchers are you thinking of?
So say an Amazon voucher, give an employee a £50 Amazon voucher or £100.
Okay, depends what that's for. Okay, now obviously, if say it's Christmas time or Easter time, whatever, and the employer provides everyone with a voucher of £50, like a love to shop voucher, something like that.
Yeah.
And that effectively can be classed as a trivial benefit, which will not attract tax or NIC. Okay. However, if that voucher is presented to the individual or to a group of individuals because of something they've done performance-wise at work, then it's chargeable. Okay. As a goodwill gesture, it can be provided tax-free. If it's not as a goodwill gesture because it relates to a performance-related or work-related piece of work or circumstance, then effectively it's taxable and nickable. Okay, and that's just up to £50. It can happen as many times in the year as they want to, the employer wants to, but they've got to be careful that it's not bleeding into obviously performance related to gifts.
So if it was an Employee of the Month award,
where
would that fall? Then that would be taxable.
Well, not necessarily. It depends what that reward is for. If it was obviously for doing what they do as a job, effectively, and reaching a sales target, then quite clearly it's performance related.
Yeah.
If it's for just being a popular good egg, then in theory you could, it wouldn't be. The thing is not to be too generous about it. You know what I mean?
Be sensible with it.
It's
another grey area.
That's right. Oh, by the way, off to Monte Carlo this weekend. Really? Thanks very much. That's a bit too much. Really.
Tell you what, your employee's nice to you, isn't it?
Yeah, it's nice. Who you know?
I thought you were tanned.
Things really wrong.
Absolutely.
That's your invite, gone.
I thought it was being nice as well. But you see your point. It's just being sensible with it.
Anyway. So then that you've got to bear in mind that £50 limit. Okay, that's once it goes over that, then the limit. There's no exemption. That's it. That's it. It's 51. It's chargeable effectively. So
So if I wanted to take my team out for dinner, or say I've got subcontractors, this is going to be a messy question, but if I've got, say, my plumbing firm again, and I work with 25 subcontractors, and I take them all out for dinner,
right?
Okay, obviously they're not my employees,
right?
So if I paid for them to go out, there's no P11D charge on that.
So we're talking they're going out with your employees.
So I'm going. So then, if they're subbing, that's a different question. But if they're employees, take all my employees out for dinner.
Okay.
At Christmas,
okay,
and it costs £200 per person.
Yeah.
Okay. Does at that point does that become a chargeable benefit, or is that me just paying for a Christmas party?
Effectively, once you go over the HMRC will allow you to take and entertain your staff like on an annual event.
Yeah.
Okay. Up to £150 per head, and that can include partners, and it can include a few guests with regard to that. Like well-established customers, but obviously or clients. But you're not to outweigh the importance you're taking your employees out.
Yeah.
So £150 per head, which will maybe include meal, drinks. Maybe the hotel cost, taxis there and back if need be, okay, but you can't exceed £150 per head, because once you go over that, then the whole lot is taxable.
So if I've got 10 employees, and actually they all take their partners, so if I've got 20, so is it £150 per person for the 10?
The cover it'll be for the 20, so
the 20.
Yeah, so it's extended to cover the partners as well.
Okay.
All right. That's
simple.
That's right. And the thing is, but then you run the risk of how do you actually then recover the tax on that? And that's where do you charge the individuals? Obviously, because obviously you'll drink more than Mark will, so that's not fair on Mark paying the same.
That's definitely true as well. Actually, true.
Mark will eat more than you will. So so it really depends whether the steak costs more than the tequila, doesn't it? Really?
Exactly what I mean. We've got to balance that.
But obviously, so you've got to try that. So if you split it evenly, some people may not accept that, okay, and then they may not want to pay that £200. Obviously, all the tax on that £200. So effectively what the employer can do is enter into what we call a pay-as-you-earn settlement agreement, a PSA, and they can pay the liability, the tax and the NIC on that.
The whole party.
And they will pay on that for the whole party, because the employer's taking you out, therefore then they should foot the bill. That's the logic behind it. And because of obviously this inequality of obviously some people drinking or eating more than others, some people having a partner, some not having a partner, then effectively it makes it fair that the company then steps up and then takes the tab and the tax and the NIC on that tab. And they do that by contacting HMRC and entering into what we call a PSA agreement, which is a pay-as-you-earn settlement agreement.
And that's done once a year, isn't it?
Once a year, yes. Yeah, obviously, once you make the record, then you can do that annually. Okay, so if the Christmas party is an annual event, then obviously and it's going to be more than that £150 per head. You could have 2 events, 3 events a year. Okay, which 1 or 2 may be covered by the £150 exemption, but 1 may not be. In which case they just pay the liability on that that one that isn't. Okay.
Yeah. I did have another question, and it's just completely left my head. So that was it. If I have more than 1 event a year, so I have, I don't know, let's just
summer barbecue,
a Christmas party,
that's right,
an Easter, bonnet parade.
How many do you want?
Only just this party.
Do you know what I mean?
No wonder you're making any money.
I've got a Tesla. That's why I can't afford to pay the petrol.
No, so
is that £150 per event? Or?
No, it's £150 annual. Okay, so effectively, you could have 2 events which are covered by the £150 exemption per head, but then you could have 2 that aren't. But you could have 2 that come up to £130 total. The next one comes to sort of like maybe £50, but that £50 will be charged in total. So even though you've got maybe £20 less than that exemption, that one gets completely swallowed up by that. By the whole charge gets taken up.
So you can see how some people will think that's £150 per event.
It's an annual thing. Okay.
There's loads of things to be aware of, isn't there? Really.
Yeah. You've also got to be careful though, the fact that obviously that if you have it's a company anniversary or a marketing event, that isn't the same as an annual event, okay? Because a 30 year anniversary is a one-off. And it's often people think they can actually use that anniversary event as being a way of actually using £150 pay, but you can't. Not in strictness, you can't. Okay, it's meant for annual events.
Yeah,
okay?
yeah.
Social annual events. Okay, you may have it. It doesn't have to happen every year, but obviously the intention, such as Christmas parties or summer gatherings, that sort of stuff.
Barbecues, my Easter bonnet parade.
That's Easter bonnet parade.
Yeah, you've got all those sort of things to to consider. Really, you can see how people would miss these, and then just carry on, and then the revenue come and ask her. So actually, one of the things that we do quite regularly, isn't it? We go out and actually do visits and actually speak to people about the things that they do and whether they will affect either POA exposure or not.
The pay-as-you-earn health checks, which we undertake, are quite useful for those that feel they may not be 100% sure about what's going on. They just need to ask a few questions, because we can take them through effectively what a HMRC inquiry would be like. Ask the questions as it would be asked of them, and it allows people to sort of say, "Oh, hang on a second, I'm not doing that right," and then it gives them the opportunity to put it right.
Before HMRC.
It's better us asking the questions.
That's right.
HMRC, they're being proactive about it.
And the trouble is, if you've been doing something wrong for a number of years, you don't know you've been doing it. It's cannon fodder for HMRC. It's a gravy train, because once they find something wrong, they can go back 4, 5, 6 years, what effectively is an innocuous amount of money of, say, maybe an understatement of £500 can become 20 grand in no time at all. So it's something just that you need to be aware of. It's a wide area to look at, and it's something that we can help with.
Yeah, and do you not stop that, Mark?
Forward planning,
exactly, and actually asking those questions. It's not nice to go through a HMRC inspection at all, but if you're prepared and you're aware of the things that roughly they're going to, obviously something new happens after the health check, then it's one of them. But if during that, at least everything will be reviewed.
That's right. Yeah.
I've learned an awful lot today.
I know, it's been interesting.
It has been really interesting.
I told you I was looking forward to it.
There's nothing else. I've got no other questions. Have you, Mark?
I haven't got any other questions now. I think we've covered quite a lot there, so hopefully everyone's found it interesting.
Yeah, that's good. I certainly have. I've learned a lot, so hopefully you guys have as well. Yeah. So thank you for your
You'll
time.
have to come down to the tax gym with me. Obviously, you give me
get me on that tax weights, I tell you.
Yeah, have a look at that. Have a look.
I'll tell you what. Get the tax guns out. Just see me on that tax.
There's a lot to be said for tax muscle.
No, there is. I don't think I've got the strength. I haven't got that in me. Mark, how's your tax muscle?
Tax muscle, better than my normal muscle.
But it's a wide area, and obviously it can be a bit of a minefield. Obviously, if anybody needs any help, just get in touch with us.
Yeah, please ask. Please. Well, thank you very much for your time. We really appreciate it.
Thanks, Andrew.
Okay. All right.
Thank you.
Okay.
So thank you, Andrew, for giving us the insight into everything, basically payroll, really. But it wasn't everything payroll.
No.
Because we are joined by Sam, who is our payroll genius. Yes. Payroll genius. We can go with payroll genius.
No pressure there. No.
I'm just putting you up here just a bit. So welcome, Sam. Thanks for joining us.
Pleasure.
So I think one of the things that I see in my world an awful lot is a thing called Directors Payroll.
Mm-hmm.
Now, is there a difference between normal payroll and Directors Payroll?
Yeah. So normal payroll is usually run for employees.
Yeah.
And this is usually run monthly, quarterly, weekly. But with the Directors Payroll, as it's just directors on the payroll, they have a standard salary. And we used to be able to run them just annually, but we changed the way of doing it and started running it monthly, which was because of some factors to do with the pandemic, and FPSs needed to be submitted at certain times, so it's just easier run, quicker payroll.
So is there a difference, so with people, say national insurance contributions and all that sort of stuff, is that on the same basis as an employee?
No, so an employee has national insurance taken it each month. With a director, they pay no national insurance until they hit threshold, which is the first primary threshold. Yeah. And then they pay 12%. until
2%. You can do the next budget. You can get rid of that.
12% from the primary threshold until the upper, which is 45, and then they pay 2%, which doesn't really ever get to that amount.
Yeah. So most of them, most. I mean, I assume most accountants will do this, where we keep the salaries quite a low value. Right about, so at the moment, I think it's about 12,000 recently, and then that's so you pay no tax personally.
No tax.
And then this is where we pull Mark in. So don't really the lights off you a little bit. So if I put a salary through my company, because I'm a director and I'm on 12,000, so I pay no tax. I've paid a minimal amount of national insurance. I'd have thought. Are there any benefits to me doing that for my company?
Yes. So within the company, you're then going to get your corporation tax relief, which now we're in April, it's between 19 and 25%. So we've gone back to really complicated ways of working out corporation tax. So we won't go into that detail now. Though.
So they're on payroll.
They're on payroll, not for corporation tax.
They'll put people to sleep with us.
So like you say, so for them personally, there should be no tax if it falls in their personal allowance, unless you're a high earner, then it will change. But generally speaking, no tax within your personal allowance, corporation tax saving between 19 and 25% on the salary you put through.
So it makes a massive difference then. So and is there a reason why we get people to contribute a small amount of national insurance?
Yeah, so there's several reasons for that. It keeps you within your state pension and your pension credits. Although that level is a little bit lower, we still like the director to pay a small amount of national insurance due to other benefits like statutory benefits, so maternity, paternity pay, and the bigger one really is if something was to happen to the client, God forbid, it doesn't, but if they couldn't pay themselves through the business any longer, due to maybe ill health, accident, then if you've paid your national insurance each year, you are entitled then to further statutory sick pay or disability allowance.
So it makes a massive difference then, really.
That part is a big part of it, really. So you need to benefit from paying smaller amount of national insurance, especially for that kind of thing. That's important.
I suppose anyone that would have been watching the YouTube video would have thought we just had an earthquake where you got the table. So anyone watching, honestly, we haven't just had an earthquake. I think Sam was just trying to add the drama with the benefits you get.
Just the point home,
just making sure. I was shaking. I was watching. But it is really important, and actually that those contributions. Because people ask me all the time, why do you do this salary? Why do you do it this amount? Why can't I just have dividends? Because I pay 7.5% taxes or whatever it is at the time, 7.5% tax on that. But actually, you're saving corporation tax. You're making you're paying no tax for your personal allowance. You're saving corporation tax, and the added bonus is you're paying a small national insurance to keep your other things going.
All benefits. It also benefits those that need the 30 hours free childcare as well.
That's an interesting point. I've never really thought about that one as much.
It does benefits those. We changed from running it yearly to monthly, so that could come into play. There was quite a few directors that needed statutory maternity pay, and a salary has to be put through monthly, not on an annual basis. And this was the same for the 30 hours free childcare as well.
Yeah, because I want to see your pay slips when you have
to
apply for it.
They need to see what has been submitted. So this is why we did. We changed it and run the monthly.
And this goes back to Mark's motto, which is always about being prepared, isn't it?
Forward planning,
Forward planning. So if you forward plan, you can have that.
We don't have to go back and change anything. It's just
This is what we look at when we do remuneration planning. It's easy for you to say, remuneration planning. It's all the factors we look at, isn't it? So when clients come to us, we look at it from all the different angles.
We do,
Because there's a lot of factors that come into play, as we've just seen there in a brief example. The things and that's just a handful of things you've listed there. There are many more. We could have another separate podcast on benefits of paying national insurance.
So where does auto-enrolment come into it for directors then?
So directors don't have to have auto-enrolment. It was a rule that was brought out with the pensions regulator. Majority of directors have private pensions, so it's not actually needed.
Okay.
Yeah, so I mean, originally the director's salary was under the 10,000 anyway, so they wasn't eligible. But now it is over because of the primary threshold going up last year. They do qualify for pensions, but they still don't have to have it. Yeah,
Well, that's quite useful to know.
it is. Yeah. I mean, we have to record it with the pensions regulator to say that they're a director's annual only, and they don't require the pensions, if you like. So as long as we record that every 3 years, it's good.
Yeah, so we can look, because that's also another thing we pull in as part of our plan, isn't it? Looking at corporation tax relief on pension contributions potentially, and actually look at the overall remuneration package that the directors get, and make sure that it's tax efficient, national insurance efficient, and everything actually it comes out. Because a lot of people, and I still see it when I pick up accounts from other accountants, that they just have dividends, no salary, just dividends.
No.
And really,
and also when we do pick up from other accountants, it comes over as a lower salary as well, where they're still not paying national insurance. So which is we then bring it over and up it, so they do pay the small amount.
Yeah, it's been quite a big thing in the news recently, the national insurance contributions, isn't it? We've been able to go back further to get your state pension qualified years and everything. So it's quite difficult. Yeah,
because it's I mean, you're a hero really when you tell someone they've got to pay any tax and their national insurance or whatever. Everyone's thinking, blimey, this lady or this guy is amazing. They've saved me a fortune.
Yeah.
But actually, they're really sort of like, exactly. There's no forward planning being done on that one. It's just been put out there. Just drop it in there. It'll be my motto at this rate, I think.
12 months of driving it in there and you've got it now.
Exactly. Blimey, yeah, you might make it a tax person as well eventually. You know, if I keep listening to you.
Well, I don't know about that.
But is there anything else with any other benefits with the sort of, particularly with the directors?
I don't think so. No, not really. It's all about just paying your contribution in, so you are eligible for all benefits.
So just a couple of quid.
A
couple of quid now
I don't think there's
benefit you long term, can't it?
Oh, most definitely, most definitely. And it isn't a lot that they're paying at the end of the tax year.
Well, they're paying a damn sight less than employees do.
But the director's salary isn't going to be for every director, so it's worth every case is different. So if you've got someone already claiming like state pension or
it's really probably not worth. But it depends on how much they're taking from their state pension. We will maybe put some salary through that brings them to their tax level, because it will still save on the corporation side of things. So we still do put it through, but depending on how much they've got coming back from their state.
It's just no point in putting one, if you're a 40% taxpayer, let's just say, paying 40% tax on it, and then actually only saving, let's just say it's the basic rate of corporation tax, 19%, and there's no, you're paying more than you're benefiting. But if you're the other way, then actually it might be.
That goes back to like when you're in the pub and your mate says to me, "Oh, I'm doing it this way. It works. Why aren't you doing it?" Because everyone's situation can be slightly different.
It is indeed.
That's what we're here to.
So what is it, Mark? It's a what basis?
Case by case.
Everything's a case by case basis.
It is indeed.
They call it. It comes with every podcast.
It's true.
Every single one. It's case by case basis. And forward planning.
It is true, isn't it?
Yeah, we've all been there.
No one's the same.
And someone saying, "Oh, I do this and this works for me," and like, because it works for you doesn't mean it's going to work for the next person.
Indeed, it doesn't.
Absolutely. Well, you go to very exciting pubs, Mark. Yours are very exciting than mine.
That's a conversation.
We'd argue about the price of Carlin. Fancy booze and I go to.
The beers are available.
Honestly. But so I think the message there is actually that director salaries are a good idea, and they are there for a reason.
Yeah, it will benefit you in the long term.
Amazing.
Most definitely.
Thank you very much.
No problem.
That's answered everything I've got. Has answered everything you've got.
It has, yeah. Learned a bit as well.
Good.
Yeah, we've learned about the hours.
Yeah, that's good. It's an interesting one.
Well, thank you very much, Sam.
Thank you. Yeah, thank you.
Thanks for joining us. I hope you've learned a lot about POE and benefits in kind today. I certainly have. And I know Neil will have as well.
Yeah, me certainly too, yeah. Probably more than you, I've learned.
Next time, we're going to be looking at R&D and things you can claim and what's involved with that. We'll have a special guest as well. If you've any queries on it, drop us a WhatsApp on 01905 777 600. Until next time, thanks for joining us.